Welcome to Bloomberg Markets. I'm Scarlett Fu. U.S. stocks in search of some direction after the latest batch of economic data, but traders cementing their bets on the Fed cutting rates by 25 basis points next week. Here's how things stand right now. You have the S&P 500. It was on a three-day rally, but that is stalling out, even as data showed that wholesale inflation did pick up a little bit here. But within equities, you do see small caps outperforming here. And the Russell 2000 gaining 0.8%. All 11 groups are higher. Telecoms and materials are leading the way up. We're seeing somewhat higher yields across the Treasury curve. The 10-year right now at 3.68%. So a little bit of the retracing of some of the moves that we saw since last week. We do have another auction today. This time it's a sale of 30-year notes in about an hour's time. The euro is firming just a hair by 0.25%, even after the ECB cut rates for a second time. We're going to dig into that decision a little bit later on and the implications from that. Let's go back to the equity side here in the U.S. and check in now with Abigail Doolittle, who has a couple of movers for us. Abigail.
Indeed, because beneath that surface of the S&P 500 barely moving, we do, of course, have a bit of a bull-bear battle. Take a look at the shares of Warner Brothers over the last 2 days. You can see the move higher today, up 7.5%. The best day in quite some time. This after a distribution deal, a new deal with Comcast. So essentially their channels, including CNN, among others, will go out across Comcast. So investors really liking this news, signaling that they think it's going to be good for the bottom line. Turning to another big winner on the day, the shares of Kroger, the grocery store, up 5.8% on the day. A pretty good pop there. And this after they raised their sales view. They're saying that they're seeing decent demand, good demand for their stores at their grocery markets, and that a piece of it has to do with their ability to lower prices while personalizing the experience. Another situation that investors are cheering. And then finally, it's not all good news, obviously, with the S&P 500 down. Let's take a look at the shares of Moderna, down about 17%. They cut their R&D budget. They're also trimming back the pipeline. This after they're seeing less pickup, less demand for the COVID vaccine. This stock, since the pandemic, down more than 80% today, a piece of that clearly. And then Micron was downgraded, down 4.6%. It's interesting because NVIDIA on the day, and we'll be looking at this around 12:30, Scarlett, up for a fourth day, a really nice gainer there, but the chip complex overall, not so much. Micron being one of those stocks among the chips, the stocks that is down.
All right, fantastic wrap up there. Thank you so much, Abigail Doolittle. And it really indicates how there's a lot of movement underneath the surface, but really the macro outlook is hanging over financial markets when you look at it from an index perspective. So let's bring in Bloomberg's Michael McKee, our chief economics correspondent, international policy correspondent as well. You cover everything.
I cover.
Mike, we had two data points today that really get to the heart of the Fed's dual mandate. We had inflation and employment data. Let's start with producer prices, which came in hotter than expected.
A little bit hotter than expected in both the headline and the core. However, most of that was in services and most of that was in trade services, which is the margins for retailers and wholesalers. So it's good news on the profit side. It does tell the Fed that the battle against inflation isn't necessarily won yet, but on a year-over-year basis, prices went down for the PPI as they did with the CPI. So the Fed is looking at still being able to stay on track to cut rates.
So the disinflation narrative is still intact when you look at it in a big picture point of view.
Yes, absolutely. We see some areas going up and down, but you've got more going down than up right now.
Okay, let's talk about weekly jobless claims, because that also picked up for the first time in 3 weeks. And I know that because it's a high frequency data point, we tend to say, oh, but you got to look at it over the longer term. Continuing claims also moved higher for the first time in 5 weeks.
Well, here you got to put on your nerd hat.
Well, we do that all day.
What we tend to look at with jobless claims, and you can see on the screen there, is the seasonally adjusted, which is the blue line. The non-seasonally adjusted white line is what's kind of mattering right now, because that would show you if there were a lot of layoffs happening, that would be going up. Instead, the number of non-seasonally adjusted claims went down by 13,000. And then, for you nerds out there, the seasonals expected it to go down by 14,000, so that's what pushed up the seasonally adjusted number. So it's not anything for the Fed to worry about. And what it tells you is that we are still seeing a labor market that hasn't changed a whole lot. We're not seeing a lot of layoffs. Companies are still holding on to workers. Now, the continuing claims rise just suggests that it's taking a little bit longer for people to find jobs. And we know from anecdotal reports, the Beige Book and things like that, that companies say they're not really hiring either.
So the issue in the labor market is that companies aren't hiring as much. The job growth has slowed down, but the layoffs haven't picked up in a material way that really is alarming to policymakers.
It doesn't seem to be a reason for them to panic yet, but they're cautious. That's why they don't want to hire anymore. Some say they're seeing additional orders, and others say orders have sort of slowed. And there's both the Fed out there as an issue and the election out there as an issue. And some people suggesting that maybe companies are just going to wait to make expansion plans until after the election. They see what the tax and regulatory regime is.
That may take a while to sort out. Very quickly here, what other data point will the Fed and therefore markets fixate on before the meeting on Tuesday and Wednesday?
Well, really isn't a whole lot. Tomorrow we get the University of Michigan, and so we'll take a look at their inflation expectations numbers. They don't move very fast, but if they do move in the wrong direction, that might give people a reason to push one way or another on how many rate cuts we get by the end of the year. But beyond that, there's nothing till Wednesday to get excited about.
And you'll be heading down to Washington to cover it all for us. Mike, thank you so much. Bloomberg's Michael McKee, our international economics and policy correspondent. All right, let's continue this conversation now and look at everything from a credit perspective, especially when it comes to the economy and what the Fed does next. Joining us now is Winnie Cisar. She is Global Head of Credit Strategy at Creditsights. She has a 25 basis point expectation for the Fed's meeting next week in terms of the size of the cut. Winnie, we're talking about traders pricing in this 25 basis point cut in September, but 100 basis points in cuts for this year. So that means that this cutting cycle begins next week with a fairly modest decline, but the next two meetings will feature one that will be a bigger cut, like a 50 basis point cut. Does that sound right?
We think that that is a little bit too dovish still. We have been in the camp to expect 75 basis points in total of cuts this year, really for quite some time. And we've tried to stay true to that most of this year, as the recent economic data still do highlight the reality that we have to balance the inflation mandate with the labor mandate. And while we have absolutely seen some signs of erosion within the labor market, we're not seeing this spike in layoffs or hearing from companies that they're planning to do broad-based layoffs, which I think leaves the Fed in pretty comfortable position to ensure that they're not easing too much too aggressively to restoke inflation, which still seems embedded in the services side of the economy.
All right, thank you for giving us that perspective. You mentioned hearing from companies. We heard from a group of banks earlier this week at the Barclays conference. I want to get your thoughts on what's been fairly cautious commentary. The headlines include JP Morgan saying analysts are too optimistic when it comes to its expenses and net interest income. Goldman Sachs warning that trading revenue could drop 10% this quarter. What was the most concerning thing that you heard out of that conference?
So I think that from an equity perspective, some of the comments were absolutely concerning. And taking a step back, we have been telling our investors within the credit universe that right now, corporate credit, especially investment grade, but also high yield, looks really quite attractive relative to equity yields, as we were a little bit suspicious about forward earnings expectations on the equity side of things. And I think that the comments from the financial services conference really highlight some of that caution that we've had around forward expectations, which have been really quite bullish overall, versus the reality that if the Fed is cutting, they're probably cutting for a reason, seeing some normalization or deceleration in growth, especially on the consumer side of things. And I think that we all know when the consumer complex starts to slow down, that really spooks the market, because effectively a consumer slowdown is the big thing that potentially could drive an ultimate recession and layoffs and a rise in the unemployment rate. That's clearly not our base case scenario, but we do sometimes think that the market tends to overreact to consumer data. And we think that maybe that is part of what we're seeing on the back of the commentary at the financial services conference.
You said that this is concerning for equities, and certainly look at the KBW Bank Index of the bank stocks. It's fallen in 7 of the 8 trading days of this month, down about 6% this month. This comes as even as regulators, the Fed specifically, have signaled that they'll ease up on capital rules, cutting in half the proposed 19% hike in capital. Is there any reason to worry that these revised rules are tough enough for worst-case scenarios for the longer term?
So our banking team has been pretty constructive on the revised rules. And as we've seen really for the past few stress test scenarios, most of the banks in general have done a pretty good job of passing those stress tests. It's always important to, understand what are the factors driving them. Mm-hmm. But when we take a step back and we look at the fundamental health of the banking system, especially the biggest banks, the regulatory scrutiny and requirements is still very, very strict. Now, when you start to move down into some of the smaller banks, into the Category 4 banks, it's a little bit of a less strict regime. But in general, we are not super worried about capitalization and fundamental credit health of the banking system. Mm-hmm. It's just whether that equity upside is still there, I think, is what the market is looking at right now.
All right, great wrap up there. Winnie Cisar is global head of credit strategy over at Creditsights. Thank you so much. Coming up, the European Central Bank announcing its latest rate cut. Christine Lagarde offering insight into what the ECB is expecting for the year ahead. We've got more details. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Now in Europe, the risks are to the downside and some factors could hinder growth going forward. That's according to ECB President Christine Lagarde. She spoke in Frankfurt after the central bank cut rates by an expected 25 basis points.
The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth.
For more, let's check in with Lizzie Burden of Bloomberg News, and she joins us live from Frankfurt. So, Lizzie, this was the second rate cut this year. Did Christine Lagarde say anything regarding the outlook in terms of future rate cuts versus what the market is pricing in right now?
Well, it's all eyes on the October meeting, Scarlett, and it's interesting, notable that they've cut the growth forecast for this year and next, but they haven't changed the forecast for inflation. And on top of that, at the press conference, as you heard there, Christine Lagarde saying that the growth risks are tilted to the downside, but there wasn't any sort of bias mentioned when it came to inflation. So you could interpret that dovishly. And yet at the press conference, Christine Lagarde had every opportunity to signal that an October cut is coming or to rule it out. And if you think back to the June cut, think how clearly she telegraphed that that was coming. Some would say she over-telegraphed that. So perhaps she's been burnt and learnt her lesson from that. Our team in Frankfurt have just reported that the ECB Governing Council members aren't ruling out an October cut yet. So they're sitting on the fence. She's sitting on the fence. She was all about leaving it data dependent, meeting by meeting, not a predetermined path, not fixated on a particular data point. And you can read into that. Before the October meeting, there is not a lot of data coming. Yeah. And that means when we get the inflation reading, if it goes down, don't read into it too much because it could go up again before the end of the year. So for now, traders have pared their bets on October, but this is what economists expected anyway. We may have to wait for Santa to bring another move to Frankfurt.
Okay, so she was careful not to tip her hand in any direction, it sounds like. Unlike the Federal Reserve, the ECB is a single mandate central bank. It fixates only on inflation, doesn't think too much about employment the way that the Federal Reserve does. So when she says that the ECB is data dependent, what specific data points, Lizzie, would you be paying attention to the most?
But that's exactly what she doesn't want you to do. She doesn't want traders to overreact to every single data point. She's trying to avoid this volatility between now and October. But of course, we're going to be looking at wages and inflation, growth. The question is, what are they focusing on more? Is the reaction function focused more on growth than inflation? But at the moment, she's trying to keep all the cards close to her chest and say, there is not a predetermined path. Hence why economists see them sticking to this cadence of quarterly cuts of a quarter point each and getting to 2.5% by this time next year.
All right, Lizzie Burden, thank you so much for the wrap up from Frankfurt. Now, coming up, home prices in the U.S. proving to be a major issue across the country, including for the upcoming election. But you look at the New York City market, it is showing some signs of cooling. We've got a closer look at housing next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. As this week's U.S. presidential debate showed, there is increasing urgency about a housing crisis in the U.S. Home ownership affordability has now fallen to its lowest since 2006. That reflects still elevated borrowing costs, as well as a severe supply shortage. Our next guest says he can't remember the last time the cost of housing was a top-tier issue in a presidential election. Let's bring in Slate Property Group co-founder and principal David Schwartz, along with our Abigail Doolittle. Slate develops and invests in $8 billion in real estate, mainly across New York City. Thanks so much for joining us today.
Thank you for having me.
So each candidate has proposed their own solution to address housing. Kamala Harris wants to give builders tax credits to increase supply and $25,000 payment assistance to certain kinds of buyers. Donald Trump wants to reduce regulations and open up federal land for housing development. Talking about New York City, would either of these solutions do anything? Would they move the needle for a market like New York City?
Yeah, thanks for asking. I think really the important thing there is we have a supply side issue. So when we really think about it, we just don't have enough units. And I think that's been going on since the GFC. So we have to figure out how do we build more units, whether it's in New York. We all know as New Yorkers we need it, but if we're in North Carolina, we need more units, Florida, California, everywhere in between. This is a nationwide issue and it needs a nationwide solution.
So how did we get here? How did we get to this point where affordability for the first time in your memory is a major focus within the presidential election cycle?
I think it's been going on for some time, but really after the GFC, we stopped producing units. We just don't produce. I think it's about half as many units a year. So we really got shot.
Why is that, though? So is that just developers getting gun shy, or the financing wasn't there?
Yeah, the financing fell apart a lot. We saw what happened with the subprime. I think there was less money in the system, more regulation, and I think we produced a lot fewer units. And a lot of the units we really produced were at the super high end. So we missed a lot of the affordable kind of units.
Right, that doesn't address the affordable housing shortage. So, of course, there are a lot of commercial buildings that are no longer really in use, given that so many people are working from home. What about the effort to redevelop those buildings, those structures, into affordable housing?
Yeah, great point. So we're actually working on the first hotel conversion to 100% affordable housing that we're doing in Queens. So we're excited. We're going to build about 318 units of 100% affordable housing and really focusing on people that really need it. We're talking about everyone from teachers and firefighters down to fast food workers. So everybody that needs affordable housing we're going to have there. And the key there is we're going to produce those units really quickly. So if it takes So if it takes about 3 years to build a building in New York, we're going to do it about half the time.
So just today, information came out that rent at the overall median price, at least here in Manhattan, it's come down. But it's come down to just above $4,300, which is probably more than the mortgage for most people in the suburbs or other areas. So that's the price at the super high end that's come down. What is the price for these affordable housing units that you're talking about, say, for the teacher or the fireman, somebody who's not making a six-figure income?
Yeah, those prices, we're going to be less than $1,000, $1,000, $800, $700, really prices that people that are working people can afford. I think one of the problems is that if prices come down at the very high end, it only helps those at the very high end. But $4,200, $4,100, even if it goes down to $4,000, it's not going to help the teacher afford a place to live.
How many units are we talking about here, though, when you talk about redeveloping this building? I mean, it's not enough to address the bigger problem, which is there simply isn't enough homes.
Yeah, we have 318 units there. Again, it's the right start. I think this is something that we can take and do across the country. So I think it's a start. We need 3 million units, and I think we're talking about 3 million units is a good start, but that's not going to get there. But we got to start with 300.
Sure. When it comes to rezoning properties from commercial property to residential property, I know there's a lot of costs involved, right? You have to rezone that, and there's administrative costs. But what kinds of infrastructure costs are most people not aware of, that, including perhaps policymakers, when they say, let's do more of these big ideas?
Look, there are lots of costs. The problem is it really is very localized. So all the local areas
in New York,
have different.
for instance.
In New York, actually, the zoning is better than in a lot of places. And we have this new proposal for the city of Yes, which is going to make it easier. So that's something that's been proposed by the local administration. And that's just going to make it easier to build affordable housing and more cost effective.
So, David, we would be remiss if we did not mention the fact that your father is Gridlock Sam. And of course, congestion pricing this year has been a big deal in New York. It was supposed to be implemented, $15 between 96th Street going on down, I believe, to 14th Street or below. And then at the last minute, Governor Hochul stepped in and said, no. I've heard more recently that they're maybe thinking about putting in some milder version of it. What does that mean for New York City businesses? Do you absorb that money that the MTA needs, and is it passed along, or where does that go or come from?
One of the greatness of New York City is our mass transit system. So we have the greatest mass transit system, but it's aging. We need more money. We need investment to that mass transit system. That's what makes New York work. Sitting in a car all day in Midtown Manhattan, I'm sure you could imagine, is not efficient. So,
but will those costs? Because right when that we had another real estate guest on set with us that day who was talking about the idea that at some point New York businesses would actually absorb those costs because it wasn't going to be coming through in the congestion pricing. Do you agree with that? That somehow it will be passed along in some other form?
I don't know the specifics of that. You could ask my dad. I'm sure he knows better on that.
Your dad, of course, being Gridlock Sam, the former New York City traffic commissioner. So you've grown up with this instinctive awareness of public transportation and transit that perhaps most developers don't necessarily have. I'm curious, when you think about congestion pricing overall, if it were to go through, is this something that's a selling point for people who want to live in New York versus other markets?
I think it'll make New York operate more efficiently. I think we're seeing traffic is a big issue, but also if you look at affordable housing, how do people get to their job? How do they get to work? So people are not living in Midtown Manhattan because the prices are $4,100 a month. So if people are commuting, mass transit's really a big part of their life. And if we want to add millions of people or hundreds of thousands of people to New York, where are we going to add them?
So we had your co-founder and principal, Martin Nussbaum, with us just a couple of months ago. Very quickly, David, I know that your financing business has picked up. Are you providing a lot of shadow banking in the real estate area?
Yeah, we are. We've seen that one of the things with the local banks having more regulation and closing down, there's a shortage of money. We need to produce a lot more units, and in order to produce lots more units, we need money. So we're filling the void where people don't have access to capital that want to build more units. We've financed thousands of units of new construction, affordable housing, and market rate housing. We need all of it. So we're really happy to be filling that void as lenders and filling the void as developers.
All right, Slate Property Group co-founder and principal David Schwartz, thank you so much for joining us today.
Thank you.
And of course, to our very own Abigail Doolittle. Now, coming up, we're going to dig further into the data we got today and what it means going forward for central bank policy. This is Bloomberg. Welcome to Bloomberg Markets. I'm Scarlett Food. Let's take a look at where things stand across the financial markets at midday. You have the S&P 500 holding on to a gain that's not very large, 0.1%. This is even after the latest economic data showed faster than expected price increases across the wholesale industry. So inflation coming in a little bit hotter than anticipated. There was also weekly jobless claims, which indicated a pickup in the number of people filing for first-time unemployment. That just cements traders' bets that we're going to get a 25 basis point rate cut next week. Within the equity space, you're looking at small caps doing better. The Russell 2000 gaining 0.8%. And there are mild losses across the Treasury curve. The 10-year yield moving up just a bit by 4 basis points to 3.69%. And worth noting here, gold is at a record high, $25.45 an ounce, up by 1.4% at the moment. Now, when it comes to that inflation data I was just referencing, PPI, the Producer Price Index, Stifel's Lindsay Piegza says the numbers should keep the Federal Reserve on its rate-cutting path.
This morning, slightly hotter than expected read on the PPI. It's not enough to negate the Fed's intentions to open the door for rate cuts next week, but it is a welcomed reminder of the Fed's ongoing focus on inflation as price stability is not yet met.
For more on what's happening across the U.S. economy, let's bring in U.S. economist at HSBC, Wang. So, Ryan, when you look at the two data points that we got today, which one is more critical to how the Fed determines its next move, the start of the rate cutting cycle? Is it the PPI print or is it the jobless claims print?
Yeah, I think that's really interesting how you frame that. And thanks for having me. Look, I think we've gotten very trained in markets over the last few years to be paying intense attention to these inflation numbers. So it's, every month it's the CPI and then the PPI. Sometimes it's the other order. And we've been watching it closely because inflation has been so high and because these two reports, the CPI and the PPI, are key inputs into the Fed's preferred measure, PCE inflation or core PCE inflation. However, what I think we've seen in recent months is that core inflation is now below 3%. It's not quite as critical as it has been over the last couple of years because we're still wondering, and the Fed is concerned with getting inflation back to 2%, but the bottom line is it's much lower than it was 1 or 2 years ago. That in turn, I think, has turned attention to the labor market, and a key reason the Fed is likely to start cutting rates next week is because of evidence of softening labor market conditions. Now, actually, this is a nuanced story because the initial jobless claims readings have been relatively benign over the past 5 to 6 weeks. I think that's giving the Fed the confidence to cut rates, but to do so with an incremental 25 basis point step.
Right, but everyone talks about how the labor market data is backwards looking. It tends to be a lagging indicator. By the time it really shows there's damage across the labor market, it's too late because it's already happening. When it comes to jobs right now, is the picture really that companies are no longer hiring at the pace they once were, so the growth in employment has slowed down, but there's not necessarily a material pickup in layoffs and firings? So that kind of gives everyone room to wait and see, but the wait and see carries a lot of risks, doesn't it?
Yeah, I think once again, you put it exactly right, meaning the initial jobless claims that we get every week, it may be one of our best leading indicators, but that doesn't mean that it's going to give you much advance notice if, in fact, the U.S. economy does at some point head into a clear recession. So that's kind of the issue. I mean, it's the best of a bad lot, if you like, in terms of what signals we can really look at to determine what's going to happen in the future. I think that's clearly why over the course of the summer there was such intense focus on those jobless claims figures. In late July, we had an elevated reading. As I mentioned, the last 5 or 6 weeks have been lower, and that's pretty much all we have to go by. I do think, broadly speaking, both the numbers that we have in hand and what companies are saying supports the characterization that you just made, which is that, look, businesses just aren't hiring as much as they used to because they filled a lot of those previously open positions. I mean, it's the most logical thing in the world. So that is leading to slower net employment growth. Mm-hmm. It's not necessarily something to be overly concerned with, but then again, markets are probably right to think, look, if businesses have reached the desired level of employment, then what is the next step? And, we're going to be, I think, just waiting for the rest of this year and into next year, always a little bit concerned that the next step could be outright reductions in desired workforce.
Right. I like how you put it. The jobless claims being a leading indicator is perhaps the best of a bad lot. The thing is, no one really makes a determination on conditions in the labor market based on weekly jobless claims, do they? Because that would be incomplete. What is it about the jobless claims that perhaps doesn't give us the fullest picture of the labor market here in the U.S.? I've read that it doesn't necessarily capture everyone. For instance, recent immigrants who can't file for unemployment benefits.
Well, I think there's some ambiguity about that. I mean, from a historical standpoint, again, jobless claims have a very strong empirical record in the data. Of course, there's so many things that are unusual about the economy today that, yes, there's always questions about what should we be looking at. And hence, we really know the Fed is looking at it using a dashboard approach to looking at the labor market indicators. For example, it wasn't just the most recent jobs report last Friday, but also the job openings and labor turnover survey that we know Fed policymakers are watching closely. So you look at metrics like gross hiring, right? Not net hiring, but how many millions of persons overall are actually being hired into new positions every single month. And that number has been slowing and has now fallen below comparable levels seen in 2019. And so for the Fed, the policymakers are thinking, okay, it's been useful in the fight against inflation to have labor market conditions cool. But wait a second, are they now cooling too quickly? Right. So I think that's the push and pull. There's also metrics like voluntary turnover, quits, and we know that is something that correlates pretty well with wage growth. And so, yeah, I think it's really a dashboard approach, and there's really no clear answers.
Yeah, I mean, when it comes down to it, investors are just desperate, looking for any kind of data point to hang their hat on and give us an answer for what the Fed does next, moving forward, kind of like a blueprint. When you look at what's on the economic calendar, Ryan, before the FOMC makes its decision next Wednesday, it does look like we have University of Michigan consumer sentiment. That's a survey, so it's kind of a soft data point. You also have retail sales next week. Will either of these move the needle at all for policymakers?
Yeah, I think, the main factors that are driving Fed policymaking are directly related to the labor market data and to the inflation data, and that's no surprise since that's really the Fed's dual mandate. However, I do think the retail sales figures and their impact on the GDP data and the calculation of how GDP growth is really progressing in 2024 is still relevant. Although there have been signs that companies are hiring less, you really haven't seen any significant weakness in the GDP data, actually averaging still over 2% real economic growth in the first half of this year. Signs that the third quarter, based on what evidence we do have, is remaining pretty resilient. So, I think for a long time, several years, really the entirety of this after the pandemic economic period, there have been concerns that consumer spending would weaken, that retail sales would fall. Well, evidence of that has been very scant, right? There's been a lot of expectations that we might see a downturn in spending, but it really hasn't happened. So I think we're just going to have to keep waiting and watching. In a way, I think that wage gains and still slower but still positive employment growth are supporting spending, right? And so once again, it may be premature and just a little bit too looking too far into the future to think that the retail sales figures are going to deteriorate in a very significant way.
All right, really good perspective. Ryan Wang is economist at HSBC. Thank you so much. And just a reminder that we do have University of Michigan consumer sentiment numbers due out tomorrow at 10 a.m. New York time after the market opens. And then the following week on Tuesday, we have retail sales, and that is, of course, day one of the Fed's policy making meeting. Coming up, midnight tonight in Seattle, Boeing factory workers could begin a strike. We've got the latest on the turbulent labor dispute next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Let's head now to our stock of the hour, and we're focusing on Boeing because union workers are tonight set to vote on whether to accept the terms of a new agreement with Boeing. If they do not agree, a strike is expected to begin at midnight in Seattle. For more on this, let's bring in Bloomberg's Sid Phillips. So, Sid, what do we need to know about the terms of this potential deal that's going to be voted on?
Yes, Boeing and the union hashed out a deal over a month, and essentially last weekend they came up with the proposals that would basically give the workers a 25% pay hike over a 4-year period, as well as other benefits. And essentially, the workers have been asking for more, and essentially they're saying that's not enough. And given the fact that this is the first full-scale negotiation that Boeing's had since 2008 for a labor deal, this is sort of a pretty big moment for the union. And so the union's the workers have basically the union's been saying this is the best deal that they could get, given that Boeing's in a precarious situation at the moment. And the management of Boeing has said that this is the best they can do, especially in the circumstances when the company is going through a rough period. They've struggled with free cash flow, they've struggled with raising money, and essentially this will act as a massive disruptor to Boeing's production and potentially crimp that ability for them to be able to add more cash and essentially dig themselves out of the hole.
As much of a struggle that Boeing's been in, there's a lot of demand for its aircraft. And I guess part of the deal includes building Boeing's next plane in the state of Washington, which is what these union members are concerned about. Is there an explicit effort to sync up the timeline for the next plane with the terms of this new labor agreement?
So far, there hasn't been. So far, they've been talking about if they decide to build a new plane in the next 4-year period, then it will be built in the Seattle area. So there hasn't really been any definitive moves towards building a next generation aircraft. I mean, there has been a lot of speculation that they will have to do it, but so far there hasn't been any sort of tentative signs from the Boeing management about them building a new plane.
All right, Sid, really appreciate your giving us the broad brushstrokes of this deal that, of course, is being voted on today. Bloomberg's Sid Phillip. Let's now get the sell-side view on Boeing with Jefferies Managing Director of Equity Research, Sheila Kahyaoglu. So, Sheila, Sid told us about what is in contention, the sticking points here. Who has leverage here?
I think they're both actually in a really good place. I think Boeing and the union have come extremely close, faster than anybody anticipated. And the headline number is 25% of a cumulative raise over 4 years, but really it's around 33%. And we were looking for a 40% raise overall. So we were factoring in about $1.1 billion headwind to free cash flow. This comes out to about $900 million. So we're not that far away. There's a few other sticking points like a ratification bonus, AMP, but I think Boeing and the union are a lot closer than one might think.
What is the likelihood that this will get through? Because I've seen research reports that indicate, it's still not a complete certainty that this will get approved, and we could see a strike.
Yeah, I think we could see a strike, but I think it'll be very short-lived. We won't go back to the 2008 strike of where we had over 150 aircraft missing deliveries in 2008, about a $2.5 billion up profit. Pull out of that. I don't think we'll see that. I think we could go to strike for a few days, and by Monday morning, this will all be resolved. That's our in-house view, at least, because I do think that they're so close to getting there, essentially 33% to 40%, and maybe a bonus or two to change things around.
So once union members pass this new labor deal, Boeing can kind of breathe a sigh of relief and move on to the next thing. And Sid had mentioned some cash flow problems. Boeing is in a position to have to improve its financials. Do you expect a share sale or some other kind of fundraising effort?
So yes, there's a lot of catalysts to get Boeing into positive territory. This is just step one and a baseline, to be honest, to get your workforce to come to work. And they're not the only person that's dealing with this. We've seen the airlines that go through it. We have some other companies as well that have looming strike deadlines in the month of September.
We'll get to that in a moment.
Yes, totally. But in terms of Boeing, Q3 is going to be another outflow, essentially in line with what we saw in Q2. Free cash flow outflow, let's just call it $2 to $3 billion among friends. That's some of the defense losses and low production on the MAX. We're looking for monthly deliveries to start to tick up. They've been in the 30s, production in the low 20s. That's an okay rate. It's not great, but as that ticks up, that should be helpful. Defense losses is the second thing we're watching. So lots of catalysts to get Boeing into positive territory. And you asked, what about the cash? Well, when you have $57 billion of debt on the balance sheet, cash is always going to be an issue. They have $12.5 billion of cash on the balance sheet at the end of Q2. Of course, they're burning $3 billion, so that gets you into $9 billion. And it's not a great place to be, but they don't need to access the equity markets. But as new CEO Kelly Ortberg has taken hold, I think to fund the Spirit deal, to go forward, I think a little extra cash on the balance sheet never hurts.
I'm glad you bring up the new CEO, Kelly Ortberg. How much credit does he deserve, or how much blame does he deserve if the deal goes through with the union members or it doesn't go through?
It's interesting you say that, because a plug for our Jefferies Industrials Conference, which we just hosted last week, and a lot of management teams don't actually meet with the union. And that was something Kelly did last week or 2 weeks ago now, where he met with the union, and it was the first time since 2008.
He was at the negotiating table.
Yes, since 2008 that a management team from Boeing has done that. So that's what we know about him from his days at Rockwell Collins. He's a good listener, so clearly that's coming through. I don't know if he's responsible for a deal. I'm sure there's many, many parties negotiating it nonstop, but he does seem to have a nice touch.
Speaking of companies that are dealing with labor strife, I want to talk about Air Canada, too, because it's now asking Canadian Prime Minister Justin Trudeau to intervene in contract negotiations with its pilots. This is a labor negotiation that's in a different place than what we've seen with Boeing and its union, isn't it?
They have a looming strike deadline on Sunday, September 15th. So they've been in negotiations since June of 2023, and it's been going on a while. And we don't know what the public wage numbers are, that they haven't been made public. We actually just hosted their union on a call yesterday. It seems like, they're not disclosing those numbers. So we could see a strike happen there. Air Canada is the dominant carrier in Canada.
It's a flag carrier.
So there's not many places to go for pilots. They're in slightly a different bargaining table than I would say Boeing's employees are.
Yeah. How are you thinking about this in terms of how you recommend these companies as potential equities to buy, sell, or hold to clients?
We continue to have a buy on Boeing, given the duopoly that it's in, and if it could get its act together in terms of deliveries, clean up the balance sheet, maybe even divest some parts of defense that are dilutive to their cash profile, we think it's a great asset. We continue to love the aftermarket names. Those are names like HEICO, FTAI, GE, that have just really been huge beneficiaries of the lack of deliveries. So older planes staying on longer, means aftermarket dollars at 30% margins plus come through for those names. And they've been hugely positive. These companies up close to 100% over the last 12 months. So that's kind of how we're driving our recommendations.
Sheila, thank you so much for joining us. Sheila Kahyaoglu of Jefferies on what's going on inside Boeing. Coming up, big pharma giant Johnson & Johnson working to maintain its status as an innovator for medical technology. We're going to hear from the CFO about overcoming headwinds from government regulation. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. The White House's new drug pricing law is not helpful to innovation. That is according to Johnson & Johnson's CFO, Joe Wolk. He is the focus of the latest episode of Bloomberg's Chief Future Officer. Bloomberg's own David Gura sat down with Joe Wolk to discuss the executive's concerns about new regulations in the Biden administration's Inflation Reduction Act. Take a listen.
The Inflation Reduction Act, as we have commented, is something that is misguided, and it's going to chill innovation. And when you chill innovation and investment in R&D, then you have less cures.
I do worry about the long-term effects of innovation. I'm not worried short-term. We're going to continue to pursue the path. Again, we've got a stable of products that will offset any of the losses that we have for maybe a few of the products that are subject to that new regulation.
I think a company like Johnson & Johnson will be able to continue being successful in the context of the Inflation Reduction Act, but the number of medicines that will be there will be less, just because less investors would be putting money into developing new medicines. So I think that that's the ultimate effect. It's going to be less attractive for investors to put money there. Fortunately, as we are globally diversified, and we have also the diversification of having medical technology and pharmaceuticals, is something that we think we can navigate better than any other company.
Joining us now with more on J&J is Bloomberg News reporter David Gura. So, David, you sat down with both those gentlemen back in June, the CEO, Joaquin Duato, and the CFO, Joseph Wolk. And, of course, they kind of inform each other in terms of how they strategize and how they think about building out the company. What did you learn about how those two men work as they try to bring Johnson & Johnson into 2024, into 2025, and for the future?
What's fascinating is how long the two of them have known one another. They both have kind of spent most of their career at Johnson & Johnson. So
they're lifers.
They're lifers. They're very familiar with one another and how each other works. And I think the beauty of the show, and what we try to get into in the episode, is that the role of a chief financial officer is changing so much. Yes, there's a huge component that has to do with quarterly earnings and the balance sheet, but it's a much more strategic-driven role than it has been in the past. And so they have this complementary relationship with one another. And Joaquin Duato is saying he really relies on Joe Wolk for his sense of where the company should be headed. And I should say, most recently, this is a company that split in two just last year. It was only a couple of years in the works. So now you have its kind of personal care business on one side under the name Kenvue, and then the other side of the business is dealing with medical technology and pharmaceuticals. So it's entering this new phase of its existence, and that's something that Joe Wolk, from a financial perspective, was so integrally involved with and worked hand in glove with Joaquin Duato on engineering that whole thing.
So in many ways, the company is a lot simpler than it used to be, right? You've got Band-Aids on the one side and then drugs and technology on the other side. Of course, the split up is something that makes things easier for investors to value, but then at some point, companies need growth, and that's where M&A comes in. Did either of them talk about what kind of deal making they're at least taking a look at or thinking about or wanting to pursue?
Talked a lot about that. I mean, this is a company with a very solid balance sheet. It's been around for a very long time and has a very good credit rating, AAA credit rating. And it's been doing a lot of M&A despite the fact that we've been in this environment where rates are quite high and one would think it would be a little bit trickier. But they're thinking a lot about the patent cliff in particular. Yes. So, you spend a lot of money on research and design, develop pharmaceutical. Obviously, in the course of doing that, you're going to spend money that's going to be a sunk cost. It's not going to amount to anything. So they are, or they have been, acquiring drugs for their portfolio as a result of that to try to get around that. And that's just one of the many kind of novel financial considerations they're having to spend more time focusing on now as the kind of pharmaceutical environment generally is changing.
What was the most interesting thing you learned about J&J?
How it all works together. So yes, they've kind of cleaved the consumer products business to one side, but the way that kind of innovative pharmaceutical side works with medical technology and how they're looking at something that we talk about so much, and that's the advent of generative AI and all that promises. I mean, something that Joaquin Duato told me that's really stuck with me is that the advances that we're going to see in healthcare in the coming 10 years are going to exceed what we've seen over the course of the last 100 years. Just what AI and its promise could deliver for pharmaceuticals in terms of not production and things like that, but in research and trying to more effectively find drugs and medication that will be efficacious and that they can bring to the market faster. I thought that kind of, both of them and their willingness to kind of enter a world that they hadn't been a part of before, that kind of design and innovation was fascinating.
So changes are coming, they're coming at warp speed.
They are, and it's it's nice, and in the context of a company that's been around for a long time, it's nice to hear them talk about that.
All right, fantastic stuff. Thank you so much. Bloomberg News' David Gura, and the latest episode of Chief Future Officer featuring J&J CFO Joe Wolk is available right now on Bloomberg.com as well as YouTube. I'm Scarlett Fu, and that does it for Bloomberg Markets this hour. This is Bloomberg.